Following the June 2026 committee meeting, the policy repo rate stands at 5.25%, the standing deposit facility at 5.00%, and the marginal standing facility at 5.50%. These figures form a dynamic boundary for the economy, creating a corridor for the price of money. The institution managing these boundaries, the apex node of the country's financial system, is the Reserve Bank of India. The RBI operates under a dual statutory mandate, maintaining price stability while simultaneously supporting economic growth. To understand the current state of the Indian macroeconomy, we have to examine the mechanics of the Liquidity Adjustment Facility corridor. Mastering this specific operational mechanism is the critical threshold for understanding how the central bank's decisions influence the broader economy. The RBI was established on April 1, 1935, under the Reserve Bank of India Act. For its first 14 years, it functioned as a privately owned shareholders institution. Following independence, the bank was nationalized on January 1, 1949, placing ownership and control entirely with the Government of India. It is the sole authority responsible for issuing and managing currency notes in India. Unlike commercial banks, the RBI does not serve the public directly. Its customers are limited to the government, commercial banks, and other financial institutions. This path saw the RBI evolved from a colonial-era private enterprise into the sovereign steward of India's fiat architecture. In 2016, an amendment to the RBI Act ended the system where the governor alone decided the policy rate. This diagram shows the decision-making engine, the six-member Monetary Policy Committee. The seats are split evenly between internal RBI officials and external government-appointed members. Every member holds one vote, but in a tie, the RBI governor, the chairperson, is granted a second casting vote. This committee is legally bound to a regime of flexible inflation targeting. Their objective is to anchor inflation at 4%, with a tolerance band ranging from 2% to 6%. If inflation stays outside this range for 3 consecutive quarters, a strict accountability mechanism triggers. The RBI must legally submit a report to the government, explaining the failure and detailing their plan to bring inflation back to target. This framework is designed to prevent arbitrary policy shifts, forcing the bank to prioritize long-term inflation expectations over short-term pressures. The physical mechanism the committee uses to transmit its decisions is the Liquidity Adjustment Facility. This diagram represents the facility as a vertical corridor. It is designed to bound the rates banks charge each other for overnight loans. The ceiling is the marginal standing facility rate, which stood at 5.5% in the June 2026 cycle. This acts as a penal rate. It allows banks to borrow emergency overnight funds. Unlike previous systems, the standing deposit facility allows the RBI to absorb excess liquidity from banks without needing to provide government securities in return. Because it does not require collateral, this facility has replaced the traditional reverse repo rate as the active floor for the entire banking system. Before banks can even use this corridor, they must meet reserve requirements. The first is the cash reserve ratio, which forces them to keep a percentage of their deposits as interest-free cash with the RBI. They also maintain a statutory liquidity ratio, requiring another portion of their deposits to be held in liquid assets like gold or government bonds. By shifting this 3-tiered corridor up or down, the RBI sets the boundaries for the overnight cost of money across India. Shifting these interbank rates is only the first step. How does that change lead to a change in the price of consumer goods? This flowchart illustrates the transmission logic. First, a change in the repo rate alters the cost of funds for commercial banks borrowing from the RBI. Second, to protect their margins, banks adjust the rates they charge consumers and businesses for loans. Third, these new borrowing costs either accelerate or throttle spending and investment, changing the aggregate demand in the economy. Finally, those shifts in demand impact prices, moving the inflation rate back toward the 4% target. This transmission is not an instantaneous process. It's a complex chain reaction depending heavily on how efficiently commercial banks pass on these costs. While interest rates are the most visible tool, the RBI is also the primary regulator of India's financial architecture. It licenses and supervises commercial banks, enforcing standards for capital adequacy and monitoring the quality of their assets. It also oversees the shadow banking sector, applying a layered regulatory framework to non-banking financial companies based on their scale and risk profile. Under the Foreign Exchange Management Act, the RBI manages India's foreign reserves and intervenes in the currency market to prevent excessive volatility in the rupee. These roles are inseparable. Even the most precise monetary policy would fail if the underlying banking system became unstable. Returning to the June 2026 data, we can now interpret the final piece of the policy, the neutral stance. A neutral stance indicates flexibility. The bank is not committing to a path of easing or tightening, but is instead waiting to react to incoming data. The reason for this caution is a split in the data. The RBI recently lowered its growth forecast for the coming year to 6.6%, while raising its inflation forecast to 5.1%. These shifts are driven by external factors, specifically geopolitical supply disruptions and agricultural uncertainty linked to weather patterns. To support the economy, the RBI has simultaneously expanded the routes for foreign capital to invest in Indian government securities. All of these functions define the institution. It is India's central bank, the authority over monetary policy, currency management, and banking stability. The Reserve Bank functions as the primary source of systemic trust in the Indian economy, its credibility anchored by the statutory 4% inflation mandate.